Have you ever seen this ad?
Help give your child a head start for just pennies a day.
That was the Gerber Life Grow-Up Plan ad that probably lives rent-free in your head. Well, as a result of Gerber's advertising, did you know that they got sued in 2020?
If this lawsuit, again, if it's correct, they'd have been better off putting that money into the savings account.
Well, in today's story, we're going to talk about why Gerber got sued and how that lawsuit wrapped up. I don't think I've seen anyone podcasting actually cover that story as of yet. And that's going to tie right into today's main topic, the top 10 redundant insurance policies that I do not have. If you're looking to cut costs and get rid of unnecessary insurance, this episode is for you. Good morning and welcome to the HopeFilled Financial Podcast. My name is Jay Disberger, your one and only HopeFilled Financial Coach, and I'm happy that you're here with us today. To get started, we're going to review the ad for the Gerber Grow-Up Plan that I teased in the intro. And as we get rolling here, know that I'm not sponsored by Gerber, and after this episode, they'll probably never sponsor me.
Gerber Life is accepting applications for their affordable grow-up plan. It's easy to help your child get off to a good financial start for just pennies a day. Free information will be sent to parents and grandparents who call now.
That pennies a day tagline is something that sticks with me from my childhood when I would be watching daytime TV.
Or you can apply right now over the phone if you'd like. The Grow-Up Plan gives your child $10,000 in whole life insurance protection now, then doubles automatically to $20,000 later.
I'm going to stop and point out here that when they're talking about whole life insurance protection, they're talking about the death benefit associated with the policy. And they do clearly call out right here that they are selling life insurance. And that death benefit doubles at a particular age. Depending on the ad you see, they'll advertise 18 or 21. And I think that's dependent on when the ad was aired. It's changed over time.
Later on, your child can buy more, up to $100,000 in total protection, regardless of their health or job.
Remember this, because this is one of the biggest reasons people like to buy whole life insurance policies for their children. And I'm going to expand on that in the main topic.
The Grow-Up Plan also builds cash value over time that you can borrow from later. Help give your child a head start for just pennies a day.
And the last thing I want to say about the ad is it's relatively transparent, saying that the cash value is something that you access by borrowing against the policy. So while I was doing research for this episode, I came across the Gerber Grow-Up Plan again and decided I'd pop over to their website to see what all that it talked about when it came to the whole life insurance that they sell. They talk about the coverage doubling. They talk about the cash value that builds over time. They talk about the guaranteed coverage for life. That's the ability to buy more life insurance later, up to that $100,000 limit, according to the ad. I'm going to jump down the page now to the frequently asked questions. The first question on here is basically, what is the Gerber Life Grow-Up Plan? It is, in essence, a standalone whole life insurance policy for children that has a death benefit that can range from $5,000 to $50,000. Now, given my past episode on life insurance, I'm really interested in the next question. Why buy life insurance for children? Well, according to the Gerber website, your child needs you to provide food, shelter, and unconditional love. But in terms of important wants for your child, giving them the gift of whole life insurance while they are young is right up there for many parents. Why? With the Grow-Up Plan, parents get the peace of mind of knowing that their child can always have whole life insurance with cash value that builds the longer that they have it. And as long as their premiums are paid, their coverage can never be taken away from them. I appreciate that Gerber highlights for us that the Grow-Up Plan is strictly a want, but why would parents want whole life insurance for their children or cash value? Before we move on from the Gerber website, one of the questions they answer is, what is cash value? Well, according to Gerber, each time you make a monthly premium payment for your child's Grow-Up Plan, Gerber Life sets aside a small amount of money. Over time, this becomes the cash value of your policy. This money is available to you to borrow against if you ever have the need for ready cash. Check out this fine print. At the very bottom of the question, it says that policy loan interest rates are 8%. Loans may impact cash value or death benefit. Now, keep in mind they're setting aside a small portion of premiums and, well, according to the website, premiums start at $3.70 a month. So only a small portion of that gets applied to the cash value. Now, before I ask you for your thoughts and before we move into the part of the grow-up plan that led to a lawsuit, let's hear what Dave Ramsey has to say about the Gerber Grow-Up Plan.
Georgia, what are your thoughts on a Gerber baby life insurance plan for our new baby? It'll be $22 a month for $35,000, and that doubles when he turns 18. Is this a good investment? Okay, let's just say out loud that you are discussing buying a financial investment from a baby food company.
Let's also highlight that the person asking the question refers to it as an investment.
Let's just say out loud that you just said that. Does that not make you giggle just a little bit? How stupid that is? I mean, really? You're going to buy an investment from a baby food company? It's stupid. Really, really stupid. Like, don't do it. Now, let's go back. Remember the Gerber whole life insurance rip-off baby plan from the baby food company. It says if you put $22 a month in, you get $35,000 in life insurance, and it doubles when he turns 18. They didn't say that you could cash it in for $70,000. They said you'd have $70,000 worth of life insurance, which, let me help you with this, that means you're going to have about a $10,000 or a $12,000 cash value, roughly. I'll be off a little bit, but I won't be off much. However, if instead of getting ripped off, you were to put the $22 in a decent growth stock mutual fund for the same period of time, you would have not $10,000 or $12,000, not $70,000 worth of life insurance, but $125,000 on average with average mutual fund growth rates.
Well, I don't think Dave left us any room to misinterpret his opinion of the Gerber Grow-Up Plan. And at this point, I want to make one thing very clear on my opinion. Life insurance exists primarily to replace income. If someone passes away and they have people who depended on their income, life insurance acts as a lump sum that can go to those dependents. They can live off of that lump sum payout, either directly for a duration of time, or they can go in and invest that money to help make it last longer. But a baby does not generate an income normally unless they're a Gerber model. So a baby doesn't need whole life insurance. You might want whole life insurance for your baby, though, if you wanted coverage to pay for a funeral. If you have a healthy emergency fund, though, that probably isn't a need. And then they talk about the cash value. Well, why would you need to be putting cash value away for your child? Well, that brings us to the Gerber Life College Savings Plan advertisement from 2012 here. Let's dig in.
Okay, so has anybody actually started saving for college yet?
Oh, not me.
No, you got time.
Oh, no, we actually started.
You have?
Really? Mm-hmm. Sure. We figure you start saving a little now, or you'll borrow a lot later on.
Yeah, but how did you even know where to start?
Oh, I found out about the Gerber Life College Plan.
Call now for free information on the Gerber Life College Plan. It's easy.
It's pretty much worry-free.
Well, how could it be worry-free? What if something happens with the stock market?
No matter what happens, we get guaranteed safe growth.
And that's typically the sales pitch for whole life policies, right? That they guarantee that you're going to be growing the cash value associated with the policy. It cannot go negative. That doesn't mean that you're getting an actual good rate of return. You're just guaranteed that it won't go negative.
So when she's ready for college, the money will be there. And it doesn't take a lot of money to get started.
For as little as $10 a week, you can start saving for college and get guaranteed growth. Just call now.
Now, I know that they say they're investing, but some of that $10 goes to the premium for the whole life insurance, as we're about ready to find out.
Oh, it's a life insurance policy, too.
Oh, that's different.
And if she decides not to go to college, there's no penalty, so she can use the money for anything.
We've got to get started.
Yes, we do, because you're going to college.
Okay, a couple things. First, I love that one mom saying, well, that's different because this sort of is. Second, they said that the money isn't specifically earmarked for college and that the child can spend it on whatever they want when they get access to the cash value, which means it probably doesn't have any tax benefits that other college savings plans would have, like a 529 or a Coverdell Educational Savings Account, ESA for short. To highlight that fact, let's look at one more video produced by Gerber.
What can you use the money from the Gerber Life College Plan for? Books, housing, tuition?
Well, turns out you can use it for anything. It doesn't even have to be for college. So let's say my daughter turns out to be an entrepreneur and she has a great idea for a business and she decides to do that instead of going to college. Well, we can actually use the money from the college fund to help her build her business, and we don't have to pay any penalties on it. We're doing some research. With this plan, if you decide to use the payout for something other than college, you don't have to pay a penalty fee. And I like having that kind of flexibility.
So he highlights not having to pay a fee as a benefit. When you have money in a 529 or an ESA, you don't use it for higher education. How do you get the money out? Well, now It wasn't the case back in 2012 when these videos were produced. Now you can take the money that is in a 529 that goes unused, and instead of rolling it over to a family member, you can roll it over to a Roth IRA as described in the Secure Act 2.0. Parents, this means that you can no longer really oversave in a 529 for college because unused funds can go right to your child's retirement with Roth dollars that are going to grow tax-free. And if you're investing in an ESA because you like the flexibility of being able to choose whatever fund you want to invest in, well, you can roll an ESA into a 529, and then that 529, after your child's done with higher education or not going to college, they can just move it into a Roth IRA. Isn't that beautiful? Now, I don't want you to just take my word for it. A couple years after those videos were produced, Business Insider released this article. It's called "The Only College Plan That's Also Life Insurance is a Bad Investment." If we scroll down in the article, we're going to find these two paragraphs, and I'm going to read them to you before we go to Gerber's website. Despite the name, the Gerber College Savings Plan doesn't offer state tax deductible contributions or the ability to withdraw and spend funds on college expenses tax-free. These are benefits you get with a traditional plan, like a 529 or an ESA. This plan is more of a forced savings account, as the actual payouts offer very little gains. Business Insider continues saying that the 529 plans are remarkably flexible. State-sponsored savings accounts with tax benefits. They're generally the default savings option recommended by financial planners. They are a better option than life insurance. And this is how the Business Insider article ends. Plus, the guarantee of the Gerber plan's cash value is contingent upon monthly premium payments like other insurance plans. In contrast, 529s do not regulate how much or how often you must contribute beyond large-scale contribution limits, and they never expire. If you open a 529 savings plan and contribute to it once, the account's beneficiary gets that money for college no matter what. Now, going back and referencing the life insurance policy again, most people can easily do better on their own, and a lot better by hiring a financial advisor to help, or even just taking the equivalent of the premium and plopping it into a 529 without even investing it in anything under that 529, just putting it in there, because none of it's getting eaten up by insurance premiums. Next, if we go to the Gerber Life Insurance College Plan page on Gerber's website, there's a little FAQ section. This time there are only 3 questions. It's really interesting. What is the rate of return? That's the first question. The rate of return varies depending upon your specific policy, its duration, and billing frequency. For further details, call them, so you don't know how much your money's growing when you're on the plan. Next, what happens if I stop paying? How much would I get? The amount you'd get back depends on when you stop paying and surrender your policy. If you are past the policy's midway point, for a 10-year policy, the midpoint is about 5 years, you would get back all the money you paid in. What about taxes? The Gerber Life Insurance College Plan will generate some taxable income. Gerber Life Insurance will send you a statement, Form 1099, to file with your taxes. This part of the website just straight up tells you that there is no tax benefit to using the Gerber College Savings Plan. Now, this is where we get into the lawsuit territory. We have a whole life insurance policy that is advertising itself as a way for you to save for your child's college. In my opinion, because children do not generate an income that needs replaced by life insurance, the purpose of a life insurance policy for a child is a little more ambiguous, and the marketing around it makes it even more confusing. And that's why this lawsuit got filed in 2020. This is a Ring of Fire video covering the lawsuit.
Scott, I grew up on these commercials. The Gerber Life Grow-Up Plan, the Gerber Life College Plan. And I'll admit, once I had kids, I thought, you know what, maybe this is the type of thing I should look into. Maybe it's something I should do. And if this lawsuit is telling us the truth, which we have no reason to necessarily doubt it, I'm very glad I didn't do that, because these plans might be essentially worthless.
I paused it because the video that I'm going through shows a Top Class Actions article called Gerber Class Action Says Savings Plans Have Zero Value. If you're curious enough to read that article, I'll link it in the description below.
A lot of people are putting their money into these plans And according to this class action, they're getting nothing out of it, or very little. It's gotten to the point now where it's not just a Gerber Grow-Up Plan where people think that they're putting this money in. Well, if they put their money in for the Grow-Up Plan for this nest egg, and they paid $260 in premiums, it's only actually worth $27.
Well, by the time my son's ready for college, that might not pay for a meal at the dorms. For our purposes today, there's not too much more to go through in the video other than the fact that you just need to know that the lawsuit is saying, hey, you advertised a college savings plan, I invested my money with you, and there's no money in there. I thought I was investing for my kid's college. I should easily have more money than what I put in, right? Why is there so very little in the cash value? The claim is that the advertisement was fraudulent because it was dishonest, allegedly. Well, only 1 year later, in 2021, there's a little brief here from the Westlaw Today website. It's today.westlaw.com. I'll link it below. And they have a little conclusion here about this lawsuit, saying the nest egg ads are misleading. We've covered those ads. We've listened to them. And every single one of those ads clearly stated that what they were selling was life insurance. I'm just going to read a little bit of what it says here. According to the opinion, the advertisements cited unambiguously described the policies as life insurance no less than 3 times and whole life insurance at least once. Each policy also featured a cash value that builds over time, as advertised, the judge noted. And while the term nest egg may be subjective, gauzy metaphor, it is not false or misleading to say that as premiums come in, the diverted cash value accrues, forms a reserve that is growing, a growing resource for the policyholder and beneficiary. Further, the fact that the product may be inferior to other financial products or carry less investment advantages does not make the defendant's marketing campaign fraudulent. Maybe Dave Ramsey would not recommend this vehicle to consumers. Nevertheless, formulating debate over comparative investment wisdom is a far cry from plausible allegation that the ads were false, fraudulent, or misleading. That was a lot of legalese, in my opinion, to say it's not fraudulent. The product is just wildly inferior. You bought an inferior product. You could have done better. And that's not criminal for someone to sell you a product that sucks. It's a free country. And that's why the main topic today is so important. I'm going to talk to you about the top 10 redundant insurance products that I do not own. Insurance products that you likely don't need either. As mentioned in the story, today's main topic is going to cover the top 10 redundant insurance products that I don't have. And since we just talked a lot about it, whole life insurance policies for children. We've got another Business Insider article on personal finance entitled, Should I Buy Life Insurance for Children? And I just want to highlight one thing from the article. This is under the section Alternatives to Life Insurance for Children. If you intend to ensure your child has life insurance options as an adult, verify your child rider policy can be fully converted into adulthood, as advertised for the Gerber plan. You should ask about guaranteed conversions just in case. On the other hand, if you're looking for a wealth-building tool or savings vehicle for your child, a child life insurance policy is not the right choice. The available whole life policies are small, with limited, if any, options for early withdrawal, and other savings vehicles will generate greater returns and offer greater access to money when needed. That article also links to another one entitled, Here's Why Your Child Probably Doesn't Need Life Insurance. This article says, life insurance is only needed by people who have others dependent on their income, like parents of minors. Life insurance can also be used to pay off debts or be part of estate planning for ultra-high net worth clients. Notice that a newborn doesn't fall into any of these categories. Outside of the extremely rare case of the child supporting the family by being a child star, like a Gerber model or a voice actor for Bluey, you simply shouldn't buy your child life insurance. And I have to agree, but I want to tie up one loose end before we let the child life insurance policy topic go, and that's going to be being able to convert that policy into one that covers your child as an adult. The Gerber Grow-Up Plan advertised that their policy could be converted up to $100,000 of life insurance without a medical evaluation. If you were trying to get a policy, or your child was trying to get a policy to replace the income they were generating for people who were dependent on them, $100,000 is not going to make a dent into what they need. So they say that they're going to be working toward this, guaranteeing insurability in the future, but it's not really going to cover you for that much if you read the fine print. And if you have a policy that does otherwise and is able to get you there, know that the odds of a child becoming uninsurable, having dependents, and not having established some sort of life insurance policy prior to that, be it term or whole, is wildly unlikely. So guaranteeing future insurability for your child is not something that, in my opinion, you really need to worry about. The second redundant insurance product that I don't have is accident insurance. I've pulled up an article from Policy Genius. Accident insurance is a type of supplemental insurance that pays out when you're injured in an accident. It complements disability insurance by allowing you to claim benefits even if your injuries don't keep you out of work. It can also supplement health insurance if your injury requires medical care that your health insurance plan does not cover. Moving down in the Policy Genius article, we find that using accident insurance is purposed to supplement other insurance policies. They talk about accident insurance versus disability. The main thing that sticks out to me is that if you're injured and your injury isn't covered by disability insurance because you can still work, accident insurance might pay you out. Then they talk about accident insurance versus health insurance. And this is where my ears perk up because health insurance is expensive. Is this a way to make things less expensive on me? Injuries that qualify for accident insurance may not keep you out of work, but could still require some medical care. You can use accident insurance to cover a health insurance deductible or copay or any other services not covered by your health plan. For example, your health insurance will cover hospital fees associated with getting stitches, but your health insurance won't pay you any money for the injury and may not even cover your entire treatment. An accident insurance policy makes sure you get a small benefit to assist you with any incidentals or uncovered costs. However, accident insurance is not a replacement for health insurance and does not satisfy the ACA insurance coverage requirements. In essence, I want you to think about it this way. Health insurance exists to defer the risk for huge costs with health-related expenses that you cannot afford yourself given what you have in savings right now. Your deductible that you have and any other costs in and around an emergency should be covered by a fully funded emergency fund once you've made it to HopeFilled Financial FootStep number 4. And let's not forget that the purpose of insurance is to transfer risk that we can't take on ourselves to an insurance company. It's not to attain a payout for every little thing that might happen or something that we feel we would need help with. Let's move on to the third insurance product that I believe is redundant and that I don't have, and that's going to be accidental death and dismemberment. Here we have an article from NerdWallet just to explain what accidental death and dismemberment covers. On this website, they have an excellent little table that covers what term life insurance covers versus accidental death and dismemberment. Because accidental death and dismemberment is a life insurance policy that only pays out under specific cases. And that's because accidental death and dismemberment insurance only pays out if you die due to an accident or you're dismembered. They talk about death due to illness or disease, which is probably the very likely way that you would end up passing away prematurely. Term life insurance covers you, accidental death and dismemberment does not. Death from an accident like a car accident, both cover you. Death from drug overdose, accident, death, and dismemberment would not pay out. Death from drunken driving by the insured, term life insurance would pay out. Accidental death and dismemberment would not. Death from suicide, again, accidental death and dismemberment is no, but term life is yes, depending on your particular policy. And last, loss of eyesight or hearing or limb, that's something that life insurance isn't going to pay out if you're still alive because it's life insurance, term life insurance. However, accidental death and dismemberment will pay depending on the injury, and it's only going to be partial because you didn't die. Again, our goal with the life insurance policy is to say if we died, we want our loved ones to be able to be taken care of in absence of our income, or if we're dependent on a spouse's income. We want a policy on them that replaces their income so we can take care of the kids if that's our plan. Accidental death and dismemberment means that you basically have a restriction on the different ways that you might die, and it may not pay out when your family needs it. So it's not an alternative. If you have enough term life insurance in place that you are covered, you've got 10 to 12 times your annual income, or you've mapped out a plan where the death benefit could be invested to properly take care of your dependents, well, then why would you need accidental death and dismemberment on top of it? Because if you die, you're not double dead. And if you die due to an accident, you don't need to replace more of your income that's covered under term. I think it's completely and wholly and fully redundant. Let me know if you disagree with me, if you think there's actually a purpose here, an undue risk that we're exposed to that cannot be covered by any other means. The fourth insurance product that's, in my opinion, redundant and that I don't have is mortgage life insurance. Man, we're covering a lot of life insurance. This is a USAA article that I've pulled up that we're going to look into to see what mortgage life insurance is. It's from 2023. What is mortgage life insurance? Mortgage life insurance is also called mortgage protection insurance, MPI. It is a type of credit life insurance that covers your mortgage if you die before paying off your home loan. Mortgage protection life insurance protects your mortgage lender and can offer peace of mind. It protects the lender, not you. You'll know that your loved ones won't inherit a large debt, your mortgage, if you pass away unexpectedly. Let's take a step back for a moment and say that in your will you stipulate everything gets liquidated, no one gets to keep the house, and all of your net worth gets distributed to your heirs. Well, your estate, you're going to have an executor of your estate who will liquidate everything, pay off any unresolved debts, and then the balance, which is your net worth, is what goes to the heirs. Your loved ones are not going to be inheriting a debt. If you have a negative net worth, that debt doesn't get carried over to family and friends. It is forgiven. It goes away. In the United States, your children are not going to be inheriting a debt from you if they aren't keeping the house. Back to the article, it talks about how the payout, the death benefit, is equal to the mortgage. So it's going to continue shrinking as you pay down your mortgage. And the final word of the article, is mortgage life insurance worth it? It depends on your situation. If you don't think you can qualify for traditional life insurance, MPI might be a good fit. But it's important to keep the lack of flexibility in mind. Because the death benefit goes directly to your lender, it's the only financial help your loved ones will receive. You'll also need to consider whether the high premiums that usually accompany MPI work with your budget. MPI premiums can fluctuate. They're typically only fixed for certain periods of time and then can increase after that. It's responsible to think about how your family will cover mortgage payments if you die unexpectedly. But weigh all your life insurance options and make sure you're making the best decision to provide for your loved ones after you're gone. So now consider the case where you pass away and you have a spouse who's going to stay in the home with the kids. Well, they're going to still have the mortgage. If you have term life insurance, though, that is sufficient and mapped out to accommodate all deferred risk that you cannot take on yourself when you pass away, they should be able to use traditional term life insurance to pay off what's left of the mortgage and then use the rest to replace your income. You don't need a specific policy to cover the gap of your mortgage. And according to the USAA article, term life insurance is going to be way more affordable for the premium than MPI. Mortgage life insurance is simply expensive, and I really didn't like the idea that the premiums can fluctuate. I've gotten so many advertisements for this kind of stuff since becoming a homeowner. It is annoying, and they try to make it look so official that it came from somewhere where you're required to have this sort of thing, this mortgage life insurance. You're not. You're just going to get bombarded if you ever buy a place with these ads because they make a lot of money off of it. All right, the fifth redundant insurance product that I don't personally have is Hospital Indemnity insurance. What I have in front of me now is an article from Forbes. What is Hospital Indemnity insurance? Jumping into the heart of the article, you're going to find that Hospital Indemnity insurance is very similar to accident insurance, but it's specific to whenever you have a major payment due to a hospital. Hospital Indemnity insurance provides a payout to you based on circumstances related to hospitalization or other specific healthcare services. Typical health insurance has specifications on covered services, whereas hospital indemnity insurance can be distributed in whatever way you need, i.e., it's a check cut straight to you if you went to the hospital for a particular service. This type of plan doesn't have deductibles coinsurance, or network restrictions. Circumstances that would generally lead to a payout would be hospitalization, intensive care, critical care. Some hospital indemnity insurance policies also cover outpatient surgeries, ambulance services, and emergency room visits. Hospital indemnity insurance policies may also cover your spouse and family. This is another thing that I have run into in my personal experience with employer cafeteria plans. What doesn't hospital indemnity insurance cover? Hospital indemnity insurance does not cover medical care. Like health insurance, it is not a substitute for health insurance. It's instead meant to supplement a health plan. Supplement. Hospital indemnity insurance won't help you and your regular doctor visits and tests. It is meant for more serious medical needs, such as hospitalization. Hospital indemnity insurance policies also have limits, including hospital daily benefits set to a particular dollar amount. It could be $100 a day. It could be $1,000 a day. Hospital benefits limited for total days, such as 180 consecutive days. Intensive care unit benefits, which could be 200% of the daily benefit, for example. Benefit reductions to a certain age, such as 70. So as you get older, the benefits pay less and less. Now, I want you to consider this. It's not a need, it's a want. The payout, unless you're in the hospital for a ridiculously long amount of time, is not going to be significant. Well, I'd argue that it's more appropriate for us to make sure that we can handle our deductible using our savings, be it money we've set aside specifically for our health insurance deductible or our emergency fund. And if we do that, then this insurance is simply redundant to the emergency fund. It is not deferring risk that we can't take on ourselves. It's deferring risk that we should be responsible for. Coming in at number 6, cancer insurance. I have an article from healthinsurance.org pulled up because I want to share something with you. You'd think with the name cancer insurance that this is coverage to help you get through cancer if you're tragically diagnosed with it. What is cancer insurance, though? Cancer insurance, also known as specific disease insurance in some states, is a specific type of supplemental health insurance that pays a cash benefit for various cancer diagnoses and treatments. You can use the money to pay out-of-pocket medical costs and other expenses, including travel, lodging, meals during treatment, childcare, and home health services. Cancer treatment is intended to supplement a comprehensive medical health plan and is not suitable to be a person's only coverage for healthcare. I.e., if you get diagnosed with cancer or receiving cancer treatment, this pays you a lump sum, just like accident insurance and hospital indemnity insurance. But now we're even narrowing the scope tighter to being just cancer stuff. If we scroll down in the article, what doesn't cancer insurance cover? Cancer insurance policies are not designed to cover all of your medical costs a person may incur when being treated for cancer. The average cost of cancer treatment in the first year after diagnosis is $41,800, but costs can run much higher than that. Treatment of some types can exceed $1 million. The bulk of the costs of cancer treatment should be covered by major medical health plans, and no cancer policy can replace the need for major medical coverage, i.e., your health insurance has got you covered if you're going to need treatment for cancer. Now, I don't know of a health insurance plan that says, no, we're not going to pay things out if you have cancer. I know of some limitations, like for my cost-sharing ministry, if you get diagnosed with cancer, you have to call them, tell them, hey, I've got cancer, expect that you're going to be seeing bills on this so that you can give them a fair warning. If you don't give them a warning, they might not work with you as easily. But the point being made here is that cancer insurance is redundant, and it's meant to cover the sorts of expenses that you should be able to take on through your emergency fund. It is not diverting undue risk, and it's popular because cancer is terrifying. We hear cancer insurance and we think, I need insurance against that because if I get cancer, I don't know how I'm going to deal with it. Well, in reality, the undue risk you likely can't take on is covered by a good health insurance plan. The 7th redundant insurance product that I don't have is gap insurance. I have in front of me now a NerdWallet article called What is Gap Insurance and How Does It Work? What we're going to find reading through the article is that gap insurance is kind of like mortgage life insurance, but in this case, it's covering the gap between what you owe on the car and how much the car is worth if the car is totaled. So it's like life insurance on your car if you're upside down on the car. So imagine you had a vehicle that was worth $30,000 when you bought it. You drive it off the lot, you drive it for a year, and now all of a sudden it's worth $24,000, but you still owe, say, what, $27,000 on it, hypothetically. Well, if you owe $27,000 and you total the car, and insurance pays you the value of the car, your auto insurance, you have coverage on it, and they pay you $24,000. Well, there's a $3,000 gap right there that you still owe the auto loan lender, and you need to get that money from somewhere. Let's just jump right to the question we all want answered. Is gap insurance worth it? You don't need gap insurance unless you lease a vehicle, because the person who leased you the vehicle wants you to have that kind of protection, and in some cases require it because it's protecting them. Or you have a loan. You also don't need it if your loan is paid down below the value of your car. But if you have a lease or a loan, you may want to think about whether you can afford to pay the difference between the amount you still owe and the value of the car, if you have an emergency fund that's sufficiently built up. If you couldn't make that payment or don't want to deal with that financial stress in an emergency, then you'd probably benefit from having gap coverage. I want to say now, if you're following the HopeFilled financial footsteps, you have an auto loan, you're probably going to be at this point on HopeFilled financial footstep number 3, where you're paying your debt down, if not one of the earlier steps. So you're not going to have a fully funded emergency fund. Your starter emergency fund may cover the bulk of the difference unless you're really upside down on a vehicle. And if you didn't have gap insurance, but you totaled the car and you were upside down a lot, you didn't have enough emergency fund to take it on, you're just going to end up adding that debt, that difference from the auto insurance payout and the value of the car. You're going to add the gap onto your debt snowball. You're going to add it into HopeFilled financial footstep number 3, paying your debt down. And in most circumstances, I think that's a kind of risk that we can take on ourselves. If it were me and I were upside down, I'd probably want to save the difference on the premium for the gap insurance and just add that to my snowballs so I can get out of debt faster. The 8th redundant life insurance product that I don't have is actually one that's optional every time you rent a car, rental car insurance. And I've got an article here from caranddriver.com. Caranddriver.com says a couple interesting things, and they answer it straight up for me. They say, first off, some credit cards have rental car insurance built into them. So if you rent a car with a particular credit card, it probably has the rental car insurance built in. Better than that, though, if you scroll down even further, they point out that a lot of auto insurance policies actually include coverage for rental cars. I know mine does. So understand your own auto insurance policy. If you have coverage for rental insurance, if you go and rent a car, you're covered with just your normal auto premium. There's no point in you buying the rental car insurance when you get there. The last time I went to go rent a car while we were traveling in California, I went there, they asked me, hey, you declined the insurance on the vehicle. Are you sure you want to do that? And I said, yeah, I'm pretty sure I want to do that. And they said, well, what kind of auto insurance do you have? No, they didn't ask me that first. They asked if I was sure. When I told them that I have USAA, they're like, oh, okay. They knew at that point that I had rental car insurance coverage built into that, and they weren't going to try to sell me on it anymore. But because I knew that, and I was informed, they couldn't sell it to me. They tried anyway. Not very well, but that's the way this game goes. While we're talking about cars, let's move on to number 9, the 9th insurance policy that is redundant that I don't have. And that's going to be windshield repair insurance or windshield insurance. I have now a Forbes article called, Here's the Car Insurance You Need for Windshield Repair. Need is, in my opinion, used incorrectly here. If we scroll down into this article, you're going to find little bits and pieces about windshield repair and how auto insurance ends up covering whether or not something is covered in the way of the windshield. And you'll find that auto insurance often has a $500 deductible, but it costs $250 on average for the glass cost replacement, meaning that with most auto insurance policies, your deductible is probably going to exceed the cost of replacing a windshield. for most cars, most situations, and most policies. Well, what does that mean? That means if you end up damaging your windshield beyond repair, meaning it needs replaced, well, your auto insurance isn't going to pay anything for it. It actually falls entirely, in that circumstance, in that example, on average, in your camp. But again, a $250, $300 windshield replacement should not be a risk that is undue to us. We should be able to pay for that sort of thing. It's not a massive amount of money that we'd be out if we had to go and replace a windshield. So why do we need insurance for it? Insurance exists to transfer undue risk that we cannot afford. Even your starter emergency fund should be able to cover this one. Last but certainly not least, the 10th redundant insurance product that I don't have is a home warranty. And here I have a US News article called "How Does a Home Warranty Work?" And I'm going to provide you this article for reference, but in the end, they cover right here in the middle, are home warranties worth it? Pros. They cover old appliances. This is what a home warranty does. You buy a home, they'll try to sell you one of these. In some cases, they might require it for the first year. It'll cover old appliances. It reduces out-of-pocket costs for repairs or replacements, and it helps sellers cover unexpected costs, or in this case, buyers. Helps a buyer cover an unexpected cost. Now for the cons. Requires service fees each time a claim is made on top of the monthly payment, the premium, if you will. It's not insurance, it's a warranty, but it's got a monthly cost. Doesn't generally cover pre-existing conditions. Wait a minute. It doesn't cover pre-existing conditions. Excludes outside contractors for the most part, depending on the company. So they restrict who can service you. You always have to pay a service fee when they send their guy out. And if they deem it a pre-existing condition that's not covered, they just don't cover it. Well, let's see, what does it cover? Electrical work, duct work, heating, interior plumbing, water heater, so a number of appliances and general building systems. Things that are typically covered in a home warranty include air conditioning, dishwasher, garage door opener, garbage disposal, oven, ranger, cooktop, refrigerator, spa equipment. And for the refrigerator, for some reason, it may exclude the ice maker. I guess ice makers break down as often as McDonald's ice cream machines. If we scroll down, what don't home warranties cover? Pre-existing conditions. I'm going to guess that means it's not like a detachable part of the house, like an appliance, a furnace, or a water heater, and it was a problem that was there. Improper installation and misuse. Oh, so if someone put something in wrong and it was damaged because they deem it improperly installed, they won't cover it. Or if you decided to misuse your refrigerator's ice maker. Home appliance or system still under a manufacturer's warranty. So if there's a manufacturer's warranty, you'll probably still pay the service guy to come out and look at it, but they'll just say, oh, I'm not going to touch that. Cosmetic defects, pest damage, which is something that your homeowner's insurance should definitely cover. New equipment that's been modified or changed, they're not going to cover it. Well, there are a lot of things I've tried to do myself. Last is secondary damage due to a dishwasher leaking or flooding from the kitchen. Again, something that you should probably have on your homeowner's insurance. And unlike some of the other policies that we've talked about today, this one can be a little bit more expensive. This one can run you on average $400 to $600 a year for the home warranty. I had one back when I lived in Utah. I had a condo. You've heard me talk about it before if you followed for a while. And if you don't follow, please follow, like, share, and subscribe. In this condo, I was told that I needed a home warranty when I bought it, and I was, as a new home buyer, not well informed enough about them. I don't even know if it was required of me to have it or if it was just sold to me. I renewed it the following year after the first year was up and looked at it as, what does this actually cover? I didn't really dig too much into it, but it was a warranty on the home. It was going to cover stuff, right? Well, one day the furnace started kicking on and then kicking off, then kicking on, then kicking off. Well, according to this policy, according to the home warranty, they're going to cover furnaces if the furnace has a problem. I haven't done anything to this particular furnace, so I have no problem calling them up. But just to have their guy come out cost a good little chunk of change. He came out, he took off the panel to the furnace and goes, yep, Thermometer's dirty. He wiped it off with a cloth. Something I probably could have solved with Google. And I'm like, that's it? He's like, that's it. And then I got the bill for the service fee. I don't think if I called someone who wasn't through the home warranty that they would have charged me the entire service fee for coming out and wiping off the thermometer. This told me that if I had someone come out and I had to pay the service fee, I did the math, I did the break even, it wasn't going to make any sense. I canceled it and then eventually needed to replace the hot water heater shortly after. Well, the hot water heater was $1,000. Might have actually been a little bit shy of that. And that was in the emergency fund. I was able to take on that risk myself. And it occurred to me that the home warranty covers a whole bunch of things that I should be able to cover out of pocket. I don't think a home warranty is a need. I think it's redundant to your emergency fund, and I think the undue risk is covered under your homeowner's insurance policy. Well, that's it. Those are my top 10 redundant insurance products that I don't have and I don't think you likely need. Please tell me what you think about this in the comments below. Let me know if you get rid of an insurance policy that was redundant as a result of this episode. And if you disagree with these, you think they fit a need, they fit a common need that applies to many listeners, please let me know about it. I'd love to cover that in a future episode, either to correct myself or continue the conversation. And until next week, until next Tuesday, budget bravely and enjoy your hope-filled financial future.